Right guys, this is a completely unplanned video. We are looking at some urgent news that's coming out regarding USDC. USDC has fallen to 0.91, and the question on everyone's mind probably is, how bad is this really? What is going on, everyone? Welcome back to the Baking Analyst channel, and today we're going to be talking about how the banks have failed again and how bad it is likely to affect things in crypto, especially now that USDC is trading at 0.91. We'll be going through what exactly happened, what has been revealed, and finally moving on to look at an analysis of how bad the situation is really. And then you'll be able to hopefully make a decision on whether you A, wants to dump off your USDC, like that person who just swapped 2 million USDC for 5 USDT cents, or if it is a good arbitrage opportunity. So hopefully you find this video helpful. Let's jump right into it. Now, the entire debacle is actually being caused by the failure of Silicon Valley Bank. Silicon Valley Bank is a regulated bank, just like Silvergate, but Silicon Valley Bank is quite a lot wider in its scope. It basically caters to startups in Silicon Valley, therefore the name. And as we all know, the higher interest rates, the rate hikes and everything have really dried up fundings for a lot of startups. Tech companies have been laying people off. Crypto companies have been laying people off. And all this investment is drying up because, why risk so much when you can just put your money into a treasury that's paying out 4 or 5%? The reason why Silicon Valley Bank was starting to fail was because it was holding a lot of treasuries that it purchased back when interest rates were low. So it thought that these were low risk investments that could pay out over time, and those were yielding about 1.79%. Now, when interest rates go up, bond prices come down in order for the coupon on the bond to match the current yield. So let's say you have $1,000 face value bond, it's paying out 1%, so that's $10 a year. Now, let's say the market yield has gone up to 3%. Now, that $10 now has to make up equivalent to that 3% yield on your bond value in order for investors to want to buy it, or rather, in order for there to be a buyer. And as a result, your bond is going to sell for much less than $1,000 because $10 on 1,000 is lower than the market risk-free rate. That was the first catalyst. And the second catalyst was when people started withdrawing their money from Silicon Valley Bank due to this whole drying liquidity situation. People needed cash, startups needed cash. And once they started doing this, it all unfolded very quickly. This was a classic run on a bank situation. The bank did not have enough cash to pay out, and therefore it had to be forced to sell off these bonds at a loss. How does that affect the entire crypto space? Well, quite a lot actually, because Circle just announced that 3.3 billion of their approximately $40 billion of USDC reserves are at Silicon Valley Bank, which is problematic, I guess, because in this case, that means about 8% of their assets are currently impaired. Now, whether or not it is fully recoverable or irrecoverable, or anywhere along that spectrum remains to be seen. But this tweet has led to huge panic among the crypto crowd, where people have been selling off their USDC, with one person even selling a couple million of USDC for a couple of Tether cents. That has become the meme of the past night alone. And today, what we're going to have a look at is how bad is the situation really? Is this just the beginning, or is this a good arbitrage opportunity? So in order to do that, we need to understand a few things. First of all, 3.3 billion represents about 8% of the assets held by Circle. Now, we are assuming in this case there are no further contagion events, which cannot be ruled out because banks are all connected in pretty opaque ways. You can't check it on the blockchain like we do in crypto. So that is one area of uncertainty right here. The second thing that we need to understand is this idea of FDIC dividends fail banks. So on top of the insured deposits, which are guaranteed up to a certain amount for your regular smaller depositors in the bank, the people who are unsecured or people who are not insured on the deposits are entitled to dividends on the residual values of what is recovered from these failed banks. Now, the key idea to this entire thing is that usually, and most of the time, something is at least recoverable. So if we scroll down over here to this tab over here, we can select a random bank. Let's say Valley Bank, because you know what, Silicon Valley Bank, they're kind of related. But anyway, that's a completely different failure event in 2014. They paid out 65% in a dividend, and another one over here, they paid out 45% as the initial dividend, which by the way is typically paid out within a week. This amount is determined by the FDIC based on an estimate of how much is going to be recovered. So in this case, we see things like 45%. Just now there was a 65% payout, and if we go to another one, that was a 55% initial payout. So this is looking not too bad already. I actually found a case where there was a really low initial payout. It was something like 7.867%, but that was just, after all, the initial deposit. The next one was 2 years later. So this could be the worst case scenario. You could have a 7% recovery rate. So with that being said, let's have a look at how bad the situation actually is by looking at this analysis spreadsheet over here. Now what I've done is taken the total outstanding USDC. So this is about 41 billion, as you can see on CoinMarketCap. And then what I've done is looked at the total impaired, which as we saw on the tweet earlier was $3.3 billion. So this leaves us with a redeemable market cap, assuming no contagion, of $37.7 billion. Now this box down here shows you the dollars per USDC fair valuation that we are looking at, assuming a 0 recovery rate. And that currently is 92 cents. So the market is kind of pricing in, or has already priced in, a 0 recovery rate, and is probably even more fearful than that. It's pricing in the possibility that there's even more contagion, or Circle could have reserves there, even more impaired somewhere else. Now, looking at this figure over here, we do also see this with recovery section, and this fluctuates based on the projected recovery rate. So let's say we have the worst case scenario, our dividend later this week that gets paid out by the FDIC on Silicon Valley Bank is only 7%. Then we're looking at a fair value of USDC of 93 cents. But let's say it's a bit more optimistic and we get closer to the averages that we have seen earlier of initial dividends at about 40%. We see that the fair value of USDC currently, assuming no other issues, is about 95 cents. And it gets even better for other coins like DAI, which has also depegged because quite a bit of its collateral is in USDC. The fact that only part of its collateral is in USDC suggests that it is likely to be in a better position. And that also underscores the importance of diversifying across various stablecoins, various assets, so that you're not directly affected by one centralized issuer. Now, could this be completely wrong if some other black swan event emerges, or if more banks start to fail in a domino effect? Absolutely. But fingers crossed, let's hope that this is all contained to Silicon Valley Bank and that we get some news on what is likely to be recovered. But when we do, we're likely to see this thing go back to more normal levels. The good news, of course, right now is that Circle is, for now, saying that USDC continues to operate normally, and with short-dated US Treasury portfolios as a backing asset, it is also likely that the yield from these treasuries should further mitigate this loss somewhat. So that's been some analysis to address the entire situation around USDC. If you're not interested in all this kind of fun and you just want to go about investing in the DeFi space and trying your luck at creating a passive income, you're going to want to check out this video over here. And with all that being said, thanks for watching, and I'll see you in the next one.